From its origins as a targeted probe of Chinese industrial practices to an all-out levy spectacle, the US-China tariff saga has escalated into a dramatic showdown, with headline-grabbing numbers that most consumers and businesses could scarcely imagine. What began in 2018 as modest Section 301 duties of 7.5% to 25% on selected Chinese goods morphed into reciprocal levies topping 125%, specialized surcharges like a 20% fentanyl-related penalty, and additional punishment tariffs of up to 100%, culminating in a maximum effective rate of 245% on critical imports. This unprecedented stacking of duties was announced on April 15, 2025, when President Trump directed a Commerce Department investigation into national security risks tied to China's dominance over critical minerals, then swiftly signed an executive order to unleash the full 245% cap on goods ranging from rare earth magnets to lithium-ion batteries. China's immediate response was a withering rebuke, dismissing Washington's tariff numbers game as irrational coercion and vowing to pay no attention to any U.S. rate hikes, while lodging a formal complaint with the World Trade Organization for violating global trade rules. Beijing's Commerce Ministry spokesman declared that China would refuse to negotiate under unilateral pressure, insisting that the U.S. must reverse its actions first, a demand echoed in a simultaneous statement that China would expand retaliatory duties on American agricultural and industrial exports by 10 to 15%. Investors around the world recoiled the moment the 245% figure became public. In the session immediately following the announcement, the S&P 500 plunged 3.45%, the Nasdaq slumped 4.31%, and the Dow tumbled 2.54% as traders rushed for safety in gold, pushing bullion to a record high above $300 per ounce. The US dollar, long a sanctuary in crises, saw its status called into question, with analysts warning that erratic tariff swings could erode confidence in the greenback's safe haven appeal. Beyond stock indices, the real economy began to feel the squeeze almost immediately. Nissan America's chairman Christian Munier warned that these duties threatened to hammer lower-income car buyers, raising the price of an average imported vehicle by 10–15% and potentially obliterating entry-level models like the Mexico-built Versa, which retail for under $30,000. Electronics giants braced for crippling input costs. A flagship smartphone that now carries a sub-5% baseline tariff could see its import levy balloon by hundreds of dollars, while semiconductor firms such as Nvidia project a $5.5 billion revenue shortfall as chip exports become untenably expensive. Supply chains, already rattled by pandemic aftershocks and geopolitical shifts, faced anew the calculus of relocation versus tariff absorption. Early indications showed a 20–30% surge in inquiries to factories in Vietnam and India from U.S. importers seeking to sidestep the highest levies, while some semiconductor assemblers quietly accelerated plans for Mexican and domestic plants to mitigate future shocks. On the political front, the 245% gambit quickly became a double-edged sword. Within the Republican ranks, the bold stance was hailed as proof of America First resolve against unfair Chinese practices. Yet, a Reuters poll of leading economists found that 62% of voters feared tariff-driven inflation, with median GDP growth forecasts slashed from 2.2% to 1.4% for 2025, and the odds of a U.S. recession in the next year surging to 45%. Democrats, meanwhile, decried the potential cost burden on families just as grocery bills and energy prices remain elevated, warning that a policy designed to protect jobs could instead cost them. Abroad, U.S. allies watched uneasily. Europe avoided mirroring the 245% cap, but launched parallel talks on semiconductors and auto trade. Japan expressed solidarity on critical minerals, yet urged both sides to de-escalate to prevent a global growth slowdown. Developing nations with nascent mining sectors, Australia, Canada, and several African states, found themselves courted as Washington offered a $1 billion fund to spur domestic rare earths extraction and recycling, a strategic pivot meant to wean U.S. defense and tech industries off China's 85% market share in those materials. Amid these high-level maneuvers lie the stories of small businesses and everyday consumers. In Ohio, Sarah Nguyen, the proprietor of an electronics parts distributorship, watched her input costs jump by 60%, forcing her to explore local forging partnerships or face shuttering her shop. "I never dreamed tariffs could triple my cost overnight," she lamented, echoing a concern shared by countless suppliers in the heartland. At the consumer end, families on tight budgets braced for a 15 to 20% surge in home appliance prices, and even the backyard barbecue looked set to be pricier, with gas grills and bicycle imports looming on the next tariff list. Today, as China and the United States remain at an impasse, with neither willing to blink first or resume negotiations until the other side retreats, the world stands at a crossroads. Will this tit-for-tat spiral force a long-overdue deal that addresses technology transfers, intellectual property, and market access? Or will painful costs for businesses and consumers worldwide simply deepen the fracture in global supply chains? What is certain is that the 245% tariff face-off has not only rewritten the rulebook on trade warfare, but also underscored how quickly economic policy can reshape markets, politics, and livelihoods on both sides of the Pacific.